Okay, let's begin. Good evening, everyone, and thank you for carving out some time this evening to join us for the eighth webinar in a series of eight. So this is our last one, and we've gotten some really good feedback on the information that we provide. The education, of course, is the key to successful recovery. When you have these kinds of events happen, and they don't happen but maybe once in a lifetime. And so you're in uncharted waters, and this is why we hold these webinars to provide some information for you to get through and navigate through the complex world of insurance claims. Uh, my name is Rino Benenati. I am one of the vice presidents of the Greenspan Company, Adjusters International. I have been a licensed public adjuster slash public advocate for about going on 31 years now, and I've been involved in pretty much every firestorm in recent history. So we're very versed in these kinds of events, unfortunately. And Greenspan itself is the oldest and most respected public adjusting firm in the country. We've been in business for 79 years, and we have a huge footprint in LA. And these webinars are our way of giving back to the community that have supported us for so long. It's the right thing to do. It's getting the information out to you when needed and as needed. And so we just want to mention why we hold these webinars. Before we begin, we want to acknowledge the incredible devastation and emotional burden this has placed on each and everyone involved. It does not go unnoticed, and we're hoping that us sharing the 79 years of knowledge and in representing policyholders will help ease that burden for you. With that said, let's begin. There's two misconceptions usually that we see. And the first one is I have a policy, I paid all my premiums, my policy limit is whatever it is, X. This is what the insurance company will pay me, correct? And the answer to that is in a perfect world, that would be great. And my industry wouldn't exist if the insurance companies just came out and paid people what they owed them. So you really have to, the reality is you have to prove what you're owed. Because remember, folks, you're the claimant, not the insurance company. They do have a fiduciary responsibility to pay the claim, but your job is to prove to them what they owe you. Because again, you're the claimant, they are not. And the contract of insurance is pretty clear. It says when you have a claim, you have to prepare a claim, present it, and then ultimately it's going to get negotiated. So simply having a policy and paying the premium doesn't guarantee you're going to receive the full policy limit without it being justified. The second misconception we hear a lot is my insurance is being really cooperative and they have put me in a temporary residence. Well, the insurance company is legally obligated to provide these advances and accommodations as per your contract. Well, look, I'm going to refer to the policy as a contract. Sometimes I'll say policy, sometimes I'll say contract. They're interchangeable. Ultimately, it was a policy until you activate it with a claim. Now you're subject to the conditions and definitions of that contract. And that's important to recognize. This does not necessarily mean they're cooperating beyond their legal obligations. So as long as they're operating within the four corners of that contract, then all is good. Contracts are subject to interpretation. Adjusters are adjusting numbers. And so, with that said, everything's negotiable. It's understanding how the policy responds and how that verbiage is used to settle claims, which is important. That's what we're going to be going over. The policy is really a contract. And again, you're subject to the conditions and definitions of the contract. We're going to dive into the anatomy of a policy. Next slide, please. Okay, so the way most of you hopefully have looked at your policy by now. I did speak to somebody earlier in the week, and I was shocked to learn, this is in the Palisades, that they haven't even looked at the policy, and they've suffered a major loss. It's a total loss, and it just behooves me or behooves you to know what the policy / contract is and what your benefits are. You cannot rely on the insurance company to teach you how to get more money from them. That's not what they do. So most of you have noticed that your policy breaks down into these 4 buckets of coverage. They're listed generally as A, B, C, and D. I think State Farm's the only one that has A, uh, B, and C. It's a little different, but we're going to speak in general terms. So A is the dwelling. And if you look at the bubble dots there, the green bubble dot up at the top has sub buckets of coverage under it. And one of those is extended replacement cost. That's an endorsement. Code upgrades is another part of the coverage A bucket dwelling. You have debris removal under that and also landscaping. So for each coverage, there are sub coverages and sub limits and special limits. And so when you look at your policy, you may not see everything listed on the declarations page, which is the page that shows you all the numbers, what the limits of insurance are. A lot of language sometimes is hidden in the body of the contract. And we'll go through all that. And so again, under A, you've got these other coverages. B, the yellow bubble dot to your right, other structures, and that's anything that is detached from the main structure, fences, pools, cabanas, retaining walls, workshops, etc. You may have sublimits there as well. An extended replacement cost endorsement may apply. Code upgrade may or may not apply, and debris removal as well. Coverage C, personal property, the one in the bottom, dark blue. Those have some sublimits as well. Scheduled items, extended replacement cost may or may not apply, and of course, debris removal. And then lastly, your bucket D, loss of use. And under that, that takes care of your housing and furnishings, leasing or renting of furniture, animal boarding, RV boat storage, and extra mileage is also covered. And again, we're going to get into specifics of each one of these buckets of coverage, A, B, C, and D. But before we do, a little bit of housekeeping. For those of you that have not ordered a certified copy of your policy, please do so. We urge you to do so because the certified copy comes right from underwriting. It takes a few weeks for them to generate it. And what that is the latest language, contract language that is in place at the time of the loss. Now, as you all know, your policy goes from 1 year to the next, and you pay your premium, and then maybe halfway through the year or 4 months into it, you'll get a 1-page notice from the insurance company, and it says California endorsement change. And most of us just stick it in the file cabinet or the drawer. But that's the insurance company basically changing the language of the contract mid-year. They have the right to do it. They wrote the contract. You didn't. And so with a certified copy, it'll be the current rule book. And folks, if you don't have the current rule book, you are not in the game, period. Let me just lower this volume here. Okay. And so that's important. Order a certified copy from your adjuster or from the adjuster, the representing the carrier, not so much from the agent. Also, for those of you that have a mortgage, I want to talk about that. You have to call the loss draft department, LOSS as in Sam, draft department, and notify them of the damages to the house, whether it's a smoke loss and you're having an impending settlement come in, or if you have a total loss. And the reason is there's a small department in every mortgage company called the loss draft department. Their function is to take in settlement checks from the insurance company with your name on it, their name on it, and put it into an escrow account. And it will sit there until you provide them with a few documents before they release monies back out to you. Now, I want to dive into that a little bit before we get into these slides. The mortgage company has what's called an insurable interest in your property up to the outstanding note. Example, you have $1 million settlement check, your name's on it, their name's on it, the mortgage company. And by the way, make sure the right mortgage company, very important, is listed on the insurance contract, because the robot only knows and spits out a check for what it sees. And a lot of times the mortgage companies will sell off to another mortgage company or a service company. So please be sure to make sure that the correct mortgage company is listed, because you lose 4 to 6 weeks when that happens. They'll cut a check and the check's useless because you've got the wrong mortgage company on it, and they have to stop payment. They have to reissue, and most carriers will cut checks once a month, just one big check run, so to speak. So get that done. Let's get back to my example. We're talking about why you need to notify the lost draft department. So you have $1 million settlement check that gets cut. Your name's on it, their name's on it. You get it, you endorse it. It goes to lost draft. They endorse it. It goes into an escrow account, and it will sit there. Once that check clears, they should be able to cut you the difference. Now, in an example where, let's say you only owe $600,000 and your settlement's $1 million, that extra $400,000 is an unencumbered amount, and they need to cut that check to you once the insurance check clears. Okay, so again, they have an insurable interest up to $600,000. They are going to control that money, and they will dole it out, usually in thirds. That's how they give it out. But every lost draft department, whether it's Wells Fargo, Mr. Cooper, B of A, whoever it is, they all kind of operate a little differently, and their protocols are different. So you need to ask them, what is the protocol to release the monies back out to me that's encumbered, meaning the one that they have the insurable interest in, and how do they release it, and what do they need? And most of the time, they're going to need a licensed contractor's contract for those of you that are rebuilding or repairing, and they're going to need the adjustment figures, how the settlement was made, and how do these numbers match up. So those are usually the two that they'll need. Some need more, some don't. So again, your job is to find out from them what it is that they require in an effort to release the encumbered amount. Otherwise, the difference between what you owe them and the settlement check total is not encumbered, and they should cut that check to you. That's liquid cash. So that's how and why you want to call the mortgage company and the lost draft department. All right, let's dive in. Next slide. Okay, so we're gonna go right in series, right in order. A, B, C, and D. Coverage A is the dwelling. I call this the big meat and potatoes coverage. This is the big one, and usually the biggest settlement check that you'll get. We're going to use $2 million as an example, okay, of a base limit. A base limit is what you bought as otherwise known as a stated limit, a base limit. So it'll be $2 million for this slide presentation. Now, if you look under the little picture of the house there, those are your other coverages under bucket A. So you got the extended replacement cost. You've got code upgrades, debris removal, and landscaping. Let's talk about each one. These are all stackable extra coverages. Okay, so under base limit, you see extended replacement cost. It says 50%. Some policies have extended replacement cost monies available if needed, up to 50, up to 100%. Some are 20, some are 25. It's you got to look at your contract and see what was bought, what was purchased, or what they offered. So in this example, we're going to use 50%. What is extended replacement cost? Well, you have to trigger that coverage in an effort to have them commit to paying it. And what are those triggers? Well, let's, for example, say that your measured loss for the dwelling damage is above $2 million. Let's say it's $2.3 million. That's the replacement cost damages measured forensically. That's what it is, 2.3 million. And the insurance company comes back and says, okay, we agree to that, but we're going to depreciate it for wear and tear, age, condition, obsolescence. And we're going to take $100,000 off for depreciation. Now you're at 2.2 million. Well, that 2.2 million is more than the base limit of 2 million. Now the door opens up, if you would, to this extended replacement cost. You now have triggered this coverage, and you have an extra $1 million to tap into if needed. So you have to trigger it. And again, the only way that door stays closed until you breach the $2 million after depreciation's applied. Very important. Okay. So that's how that extended replacement cost works. Under that, you see code upgrades. Code upgrades, otherwise known as ordinance and law coverage in your policies, covers the difference it will cost to bring you back to what you had in, quote, pre-loss condition, plus the amount of money it's going to cost to bring your home up to code, whether it's smoked out or whether it's a total loss. And code upgrade ordinance of law also has to be triggered. And those triggers are, there's usually two. One is it has to be mandated by the building inspector's office, period. That's the mandate. That's what's called ordinance and law coverage. The building inspector's office does not, the insurance company does not supersede the law. So basically, you've got code upgrades needs to be triggered by the building inspector. That's one requirement. The other one is usually that you have to spend it on one-off fires, but in a firestorm, the rules have changed, and you should be able to collect that. And so code upgrade is Title 24, energy efficiency, low flow sinks, toilets, fire rated roofing materials, decking materials. The codes typically do change after firestorms. That's what we see. And they've changed quite a bit over the years, and they're different from county to county. So Altadena, Palisades, they may differ. So you want to look at that. And so again, they owe you back to pre-loss what you had a minute before the loss, plus what it cost to bring it up to today's standards, today's code. Now the coverages are typically 10% and up to 100%. And again, you got to look at the policy. They're all different in terms of what they offer. Debris removal is a hot topic. We're going to be getting that to the end of this presentation. We'll spend some time on it. And that is usually 5% of the 2 million. That's how we got the 100,000. And then you've got landscaping. Landscaping is 5% of the 2 million. We got 100,000. Now, landscaping has even more little sub buckets, and there are limitations there. Depending on your carrier, some have a limit of 500 up to 750 per tree, per bush, per shrub. Okay, so you have a limit of 100,000. That's the most they'll pay out, but again, it's limited to 500 or 550 to 750 per tree, per bush, per shrub. It doesn't matter if you had a 100-year-old oak that's perished, they'll only pay, whatever that sub-limit is, unfortunately. But there's money there, and these are all stackable, as you can see, and they all add up on top of each other. Now, there's another one called the additional increase due to a declared catastrophe. There's a few carriers out there that offer this benefit, and it kicks the policy up 50%, some up to 100%. So if you had 100% endorsement in this case, you'd have another 2 million. So you'd have 4 million as kind of the limit, so to speak. And so the numbers incrementally go up. So this is how we arrived at the 3.4 million. We add it all up, and that's the all-in number. I would urge everybody to kind of do this exercise so you understand what your all-in number is, and that's the most that they're on the hook for. Okay, let's go over the next part. Now, the way we see it is you have three options after a firestorm or total loss, and these are what we usually see. There's three. Either you're not going to rebuild, and you'll either clear the lot and sell it, or you'll clear the lot and sit on it, or you're going to purchase a replacement property, something that's already built. You don't want to wait all this time, and you find something in a neighboring community that's suitable and beautiful. You have that choice. You can purchase something that's already built and expedite your claim process here, so you get back into a home and your life, so to speak. Or you're going to either that, or you're going to rebuild on site. So these are your three options. Let's go over them. Option one: if you don't rebuild, what are you entitled to under the contract language and the way the Ricardo Lara's codes and insurance laws that have changed? Well, you're entitled to the base limit. In this case, it's the $2 million, assuming your loss is $2 million. You are entitled to the debris removal if you don't rebuild, and the landscaping. What you give up is the extended replacement cost and the additional increase due to declared catastrophe and code. So you basically give those up, and that's for the people that, and we've seen this quite a bit, where they just cash out. It's more money than they've ever seen in their hands at one time. They either have no mortgage or a small mortgage. They pay it off. They sit on the lot. They sell it. They take that, the insurance proceeds, and they go rent a bungalow on the beach somewhere for the rest of their living days. And that's an option. That's called the cash out. And certainly you can do that. You can purchase a replacement property. You are entitled to all these sub limits, the base limit, of course, the debris removal, landscaping, the extended replacement cost as well, and the additional increase due to declared catastrophe has a question mark because either you have it or you don't. And if you do have it, is there language in the contract that limits whatever the parameters are for you to collect that in a replacement property when you purchase something that's already built? And you are entitled to code, which is in this example 200,000. The next one is rebuild on site. Of course, you're entitled to all of it, just like if you were to purchase a replacement property. There are really no changes. Again, if you have that additional increase due to declared catastrophe, that's quite a benefit. And again, it's not common. Probably based on my 30 years of doing this, I'd probably saw 3% of the policies out there that have it. But those that do, and those that have losses that measure high, because the kind of dwelling it is, or then it really helps increase. It's always better to have than have not. That's kind of how the bucket A dwelling rolls out, and the different scenarios that come into play. Again, we're going to be talking about debris removal further down the line here. Let's go to the next slide. Yep. Next one is coverage B, other structures. And other structures are garages, workshops, fencing, retaining walls, walkways, driveways, patios, sprinklers, exterior lighting, pools, and cabanas. These are things that are detached from the main structure. Okay. And so in this example, it's 10%, and some coverages are up to 20% of the base limit of the dwelling. So that's how we got the 200,000. It's 10% in this example. You may have extended replacement cost on the other structures coverage. It's rare, but it can, we have seen it in some of these policies. Debris removal certainly is available, unless again there's mention that it's not. So again, you have to read the contract and see what's in there and how and what debris removal covers. Now, look, the debris field, if you think about it, is not just the house. It's the dwelling, it's the other structures, it's the contents of the house, it's the retaining walls, the fences, it's all that. And so hopefully you don't have any limitation that prevents you from collecting additional monies for debris removal, because it all helps. And in this example, of course, it's 10,000. And then code upgrade. Now, I saw a policy this week, oddly enough, that only gave code upgrade to the coverage A, the dwelling. I was shocked because if you think about it, if you're building, let's say you lost a 2-car garage and it's detached from the main dwelling, and you need to bring it up to code electrically, Title 24, whatever that code requirement is for other structures on the property. Shockingly enough, there was no code available in this particular instance for that homeowner, and that can sting, that can hurt. Because now you're coming out of pocket to bring that other structure up to code. So again, you want to dig in and read that language to see if it's there. And so we come up with a total of 230,000. Now, the reality is that the debris removal of 10,000 in this particular instance, you're not going to see it because it's going to go to the debris removal company. And so realistically in this, it'd be 220,000 available for coverage. Again, we have to peel away the debris removal because it's not money that you're going to get to rebuild. It's strictly to clear off the lot. Next coverage. Personal property. Personal property is the most taxing bucket of coverage that you'll ever have to deal with. For us, when we're representing a client, it's our most taxing department, we like to say. It takes a team of 4 to 6 people. There's the one person that acquires all the and recreates everything that was in the house, has to go to pricing. From pricing, it has to go to condition coding, and on it goes. And it's very time consuming. It takes a long, long time, folks. This one's really, really hard bucket. Now, under personal property, in this example, we have 1.5 million as the base limit. Sublimits are things like BPP. You see there, that means business personal property. Watercraft has sublimits to it, special limits, cash, etc. Business personal property has to be carved out of your personal property claim. So for those of you that have home offices or run a business out of the garage or what have you, I've seen it all, then you have to separate the business personal property because there's a limit, a special dollar limit on your homeowner's policy. Some are $1,500 maximum. Others are $5,000 or $10,000. It's all over the map. So you want to find those special limits, sublimits for your personal property, and you have to separate out those items. Look, I suspect that's, the reason they do that is because they want to sell you more insurance. If you're running a business, earning a profit, you should have a business owner's policy. So I just wanted to mention that that's important. Scheduled items like things like jewelry, furs, watches, special items like that we see, collectibles that people schedule are usually based on an appraisal. The insurance company says, go out and appraise that watch. Just for example, let's say it's a Cartier or a Rolex and it's a $40,000 item and it's totaled because of the firestorm. What happens is the appraised value gets put on the insurance policy. It's kind of like a rider, so to speak, and the insurance company will pay whatever that appraised value is. So it's scheduled, and that's how that works. In the red, you see ACV versus RCV and depreciation. I want to talk about that. A lot of people will always say, hey, what are you talking about? I have a replacement cost policy. And yes, you do. However, the way this works for them, the way the settlement formula works basically is you have to come up with a replacement cost policy value, a replacement cost value. And so let's take an example of a sofa. And I use this all the time. The sofa set, let's say, is $10,000 to replace. And that includes the tax. Don't forget to add tax, folks. Delivery, setup, warranties, that all adds to the replacement cost value. So for this example, we'll say, I lost a couch set. It's $10,000, Mr. Insurance Company. Do you agree? Miraculously, they say, fine, we'll agree. But it is subject to depreciation. And depreciation is taken for wear and tear, age, condition, obsolescence, and that drives the replacement cost down to what's called the ACV, the actual cash value. So ACV means actual cash value, RCV, and you'll see these in your emails and such with the insurance adjuster. RCV is replacement cost value. So again, we have a $10,000 couch set. It's going to be depreciated, and let's say they take $4,000 off. And now you're looking at a check for, or an agreed figure for $6,000. So you get $6,000, and then the question is, hey, what about my other $4,000? When do I get that? Well, you have to spend $10,000 or more on the couch set, and then they'll pay you that $4,000. That's how that works. So it's replacement cost value less depreciation will equal actual cash value, and otherwise known as fair market value, because they only owe you the used value until such time as you replace the item and you prove it to them that you've replaced the item. And so that's kind of the formula and how it works. And look, everything's negotiable. The replacement cost value is negotiable. That's a negotiable number. The depreciation is subjective, and that is negotiable as well. They like to play a heavy hand in depreciation because, look, here's the fact. The insurance companies know that most people are not going to replace everything they've lost. You're going to replace the beds, the TVs, the couch set, the dishware, of course. But all that stuff that's in the garage that we just kind of stuffed in the back and things up in the closet that you haven't seen in years. They know you're not going to replace all that stuff, and that's safe to say. So what they like to do is play a heavy hand in depreciation because they get to keep that money. They get to keep that. It's a windfall for the insurance company. And so the only way you're going to get that money back is if you spend up to the agreed replacement cost value, and then they'll give it back to you. And so this is a cat and mouse game, folks, you do not want to get into. If you can picture a cubicle farm and you go and you start replacing your items, you have to hand in receipts to somebody in a cubicle farm employee there, and they're scrutinizing everything you buy, and that will take years off your life. Okay, the way around that, the way to fast track this is to legitimately, honestly, and defendably come up with a replacement cost value, in this example, above the 1.5 million. We're just going to use an example. So we know your limit here on personal property based on this slide is 1.5 million. And you do the inventory, and it comes out to 1.8 million. Okay. And then they depreciate that 1.8, and they take off 200,000 for depreciation. Well, now you're at 1.6. Well, the 1.6, that depreciated number, is above the 1.5. And now you've got your 1.5, and that's it. They're off the hook. You're done. You've maxed it out. And that's how you fast track it. Now, again, I'm going to repeat it. Honestly, defendably, truthfully, put the list together. When we're doing it, we count the toothpicks. It's that detailed. You have to be detailed in an effort to collect all your money. Look, the numbers don't lie. At the end of the day, if the replacement cost in this example is $1.2 million, and then they depreciate 2 million, you got $1 million. For you to get that other 200, you're going to have to spend $1.2 million. But again, to bypass all that is, and if it's possible, the numbers after depreciation have to exceed the 1.5 million. You're done. No receipt going back and forth cat mouse games for the rest of your time. And it takes a long time. So be patient. We'll in the next few slides we'll show you some tips and tools and tricks and things that'll help. You have to recreate everything. Now, there's a recent law that's passed that they've now allowed you to categorize your personal property. So that's a good thing because it kind of fast tracks it. Right before those changes were made by the insurance commissioner, I mean, you could have 2, 3, 4,000 line items of merchandise. You want to talk about work? That takes hundreds of hours. And so now I don't know how many categories now they've got. It could be 70, 80, 90 categories, but that will help fast track and ease the burden on the personal property claim. Again, it is one of the most time-consuming, daunting tasks because personal property is personal. There's going to be a lot of items that you may be thinking about that either was handed down from a relative, a parent, or it reminds you of a trip you might have had and you got a piece of artwork from there. Things like that really hit home. It's personal. That's why it's a really tough bucket of coverage to deal with. Next slide. So here's some common inventory questions. Do I need to list every item? Well, to that I say, hey, look, do you want to get paid? For those of you that are thinking about litigation, that's fine. But the attorneys are going to need a list. May not be necessarily categorized, and you might need to do the every item that's in the home list because that's going to be a defendable work product for them. And so you might have two schools of thought here. One is, if I'm going to litigate, I'm going to have to prove what I lost, and maybe the category way that the insurance company is allowing may not work for litigation. So something to think about and talk to your attorney if you are being represented and thinking about litigation. So do I need to list every item? To that again, I say, do you want to get paid? Number two, what is a holdback and how does it work? We touched on that in the last slide. It's also known as, and you may see it on your settlement paperwork as full replacement value holdback, FRV. It could be called depreciation holdback or withheld depreciation. Again, they hold on to that money until you prove to them that you spent what they agreed is the replacement cost, and then you'll get that back. Huge windfall for the insurance industry on that one. Number three, how do I get my withheld depreciation? Again, you got to spend it to get it, unless you breach the limit of that personal property number, that bucket of coverage. Some inventory tips and tools. Keep a pad and pen with you at all times. I was a fire victim 33 years ago, very bad fire, very, very bad. Probably could be considered a total loss, my first home. And I remember it like it was yesterday. That's how I got into this business. But nonetheless, that's for another story, another time. I remember, waking up in the middle of the night and thinking, "Oh, did I forget to list this and that?" Or I'm driving and you suddenly start thinking about that item tucked away in the garage that could be, $1,000, $2,000. So keep a pad and pen with you at all times. Talking to into your voice chat there, into your smartphone as a dictaphone, and that helps. Draw out each room one by one. Maybe look at your home from a bird's eye view if you peeled off the roof and you're looking down from 30,000 feet, so to speak, and you start to visualize and draw it out, map it out. That helps. Visualize the drawers, bureaus, closets, including shelves and drawers. Look, and I always say this in these webinars, don't forget the junk drawer. The junk drawer, most people have one. I have two. Some have more than two. The junk drawer has money in it. It's old electronics, old digital cameras. Now the phones do everything, so you don't need that. And so it could add up to a few $100s, $500, $600, $700, $800 in the junk drawer. So don't forget that either. Don't forget what was under the bed and the dressers, etc. Use your family and friends. You do get calls after these events. How can I help? I'm sorry it happened. What can I do to help? Put them to work. They can price out items for you. They can do research for you. Thank God for the internet, because I got to tell you, before the internet, it was a lot different. Trying to research prices, you'd literally have to, walk into the stores and write everything down. So, but have them help you. It'll ease your burdens, and it will help them feel good about helping you. Photograph documentation and cloud storage. A lot of people would, if you had an event at your home, whether it's outside or inside, whether it's a holiday or not, or just a regular old party, look in the background. If you see what's on the mantle and the fireplace, see what's in the hutch, the dining room hutch, if you had one. These things will spark memories, and that's how you want to do it. You want to visualize walking into your house, and just in your mind's eye, start to slowly walk through each room. Look up, look to the left, look to the right in your mind's eye, top to bottom, left to right, side to side. This will help put together an inventory. Again, we're just trying to give you some ideas of how to do this in a way that would make better sense. We get calls months and months later. Often we get calls 9, 10 months, sometimes over a year, where people just throw in the towel, and because it's pretty much a full-time job, if you haven't noticed already. And like I said, it takes us 4 to 6 people to handle an inventory professionally and properly and put it together so that it's a defendable document. Next slide. Last bucket of coverage is loss of use, and it'll either be listed as ALE, which is additional living expense, or FRV, which is fair rental value. Let's talk about each. So ALE is your temporary coverage, your temporary housing needs. Furniture rental, you do want to rent furniture, folks. You don't go out and buy furniture, because look, if you're either going to rebuild or replace a home, you just don't know what it's going to look like, or how you're going to decorate. It's going to be kind of like a fresh palette, so to speak. So, you do want to rent furniture or lease it. Increased mileage is covered, by the way. There's an app out there called Mile IQ. It's about $5 to purchase, worth every penny. And what it does is it tracks your comings and goings daily. And if you swipe one day, you can say it's related to the fire, but on the app it says business. So, but again, if it's fire related mileage, then you swipe it one way. If you swipe it the other way, it's just personal. And so it tracks every mile, and then what it does, it's a great app. At the end of the month, it'll summarize it for your fire mileage, so to speak, and you can have that as a report. And it's great. It's a really great app. It's approved by the IRS. We all use it. It's wonderful. And in the olden days, we used to have to keep a pad and pen on the dash, and you're writing the mileage. And of course, that's the last thing you want to do. And so this app kind of does it all for you. And look, make no mistake, the increased mileage can add up to two grand, $1,500. That's real money, and it all helps. RV boat storage, that's covered under additional living expense. Animal boarding, oftentimes after these events, there's a huge run in for hotels, Airbnbs, rental properties, and sometimes they don't take pets. And so if you had to board your cats, dogs, whatever it is, they don't cover fish, I don't think, and horses and sheep and things like that. It's a different policy. But under a homeowner's, typically animal boarding is covered. Now you're either going to have a dollar limit or a time limit. Okay. If you have a dollar limit, this is important. You want to make sure that you're budgeting properly so that you don't run out of money before the house is built. Because for those of you that have a mortgage, think about it. You run out of money in that ALE account, and you're going to have to pay your mortgage monthly and the rent. That can really sting and that can hurt. So, and that could, financially bust you if you don't have this properly handled. So look at the dollar limit, budget it out. And, in the timeline is going to take a long time, 2 to 3 years, I think. If I've seen some even longer. There's a lot going on. Permits sometimes will run a little slow, even though the city may say, we're going to expedite it. We've seen all kinds of stuff happen that delays the rebuild time, whether it's deeper footings or topography issues, if you're on a hillside, code changes, things like that. And the time limit, you have 3 years. Now, for those of you with a smoker, this is important. Look, they owe you for the same standard of living you had before the loss for what's called the shortest period of restoration. That 3-year insurance code is for total losses. Okay, so if you have a smoke claim and you're displaced because of it and you're going through the cleaning process, look, the insurance company wants to stop the bleeding in this account, and so they only owe for the shortest period of restoration. And so you can't sit on your behind and just sit on the money or just kind of do it haphazardly. You have to move with diligence and dispatch in an effort to show the insurance carrier, your insurance company, that you are moving forward and trying to move the project and mitigate the loss. And so that's important because they can shut you off. For those of you with total losses, of course, you have that time limit of 3 years. But if you run out of money, it doesn't matter if you had 10 years. Once that dollar limit is exhausted in the ALE account, they're done. The insurance company owes you no more. And if you exhaust that in 18 months or 24 months and you're still not even at the rebuild phase, they're off the hook, folks, because they've paid the whole benefit, 100% of the benefit, and that's that. So you got to be careful there. The fair rental value is a little different for those of you that have California Fair Plan, and a lot do. They do comps in the area of what your home would have rented for prior to the fire, times the amount of months that you'll be displaced, and that's how that works. Pretty simple. Just make sure the comps are correct. We see a lot of times that, remember, folks, I want to mention something. There's no law that says they have to be accurate. Okay, none. I'm licensed in over 20 states. There's no law anywhere that says an insurance carrier must be accurate on the measurement of the loss. They have a fiduciary responsibility to pay the claim, yes, but you have to be accurate. You're the claimant, not them. So sometimes they'll come out, they'll measure the loss, and historically, look, we track the metrics. They're off about 40% roughly. Don't hold me to that. I'm just telling you that usually it's somewhere around there. Look at the documents that come in on the dwelling when they send in the money to pay for the dwelling damages. And this is assuming that it's not all the limit of the policy. If you got the whole limit committed to, this is a moot point, but the documentation or the measurement of the loss that they came up with may not truly reflect what you had. And again, for those of you that are litigating, You want to have an accurate measurement of your loss, because without it, it's going to be tough. And so there are a lot of errors and omissions we see with these documents that come in from the carrier. These adjusters they're sitting on 80, 90, 100 claims on their desk. They're kind of rushing through it. I don't think they mean to do it intentionally, but there's no law that says they have to be accurate on the measurement. Again, that's your job. You have to be accurate and defend that position. The carrier does owe you for increased costs due to limited housing. There's usually, landlords start spiking up the rental market, the cost to rent, and so they owe you that increase. A couple of things to think about. How do I ensure I don't leave any money on the table? Well, look, sometimes it is important to be completely transparent depending on the situation. Everybody's got a different situation going. The end game, the end result you're trying to achieve will dictate whether you telegraph or not. If you telegraph your position, you could damage your claim. So just be careful and think through what you need to talk about or the answers that you're looking for. Because if you telegraph your end game, sometimes it can compromise some parts of the claim. Don't step on the landmines. Understand what you say may impact your recovery. Know your policy. Know your contract. Without all the pages, folks, should be 50, 80, some are 100 pages, if not more. That's a contract. Know the contract. Meet with a claims consultant to explore your options, an attorney or a public adjuster. Now, the only two disciplines in California that are allowed to negotiate an insurance claim of real property is an attorney or a licensed public adjuster. Not a property manager, not a real estate agent, not an insurance agent, not a contractor, just either an attorney or a public adjuster are the only two disciplines that are available or allowed, strike that, to represent an insurance claim. Someone that knows how to negotiate claims, reach out to us. We'd be happy to answer the hard questions. You cannot ask the insurance adjuster for fear of telegraphing your position. So feel free to reach out. Do I rebuild? It depends on what your overall goal is and how your policy will respond to that goal. Again, this is a game of strategy, so to speak, and the step-by-step sequence of how these claims get put together and presented and the narrative that goes along with it goes a long way with how this settlement will happen in the back end. So the more you know in the front end and the better thought process that's put into a claim, the better the results. It's details, details, details. The more details you hit them with, the less they can argue. When you leave things vague with an insurance claim, it's open for interpretation, and it won't be on your side. Do you have a mortgage? If so, what is the balance? It may play a role in your decision-making, whether you rebuild or not. What are your restrictions, if any? Code, does it transfer if you don't rebuild? The answer is yes. If you purchase a replacement policy, a replacement property rather, is that important, and how might it affect your recovery? Should you buy instead? If I buy instead of rebuild, how do I structure the deal? What upfront commitments are needed? And again, this is all part of the strategizing. There's no black and white in claims. It's all gray. We live in the world of theory, okay? And so understanding how to properly prepare, present that claim, and negotiate it is what the key to successful resolution is. The next slide, I believe, is going to be debris removal. Nope. I stand corrected. I would urge you to take a screenshot of these next slides. These are the recent California Insurance Commissioner changes outlining the critical consumer protection for wildfire survivors. Most of this stuff is for a total loss, but the good news is that you have the code sections listed there, and so you can refer to the California Department of Insurance and the code sections so that you're able to reference and get some solid answers. These are all changes that were not in effect. A lot of these weren't in effect a few years ago, But because of the recent firestorms happening every year and two, sometimes three times a year, it's like we've never seen it before. It's unprecedented. So take a screenshot of this. This will help you through some of the processes. Okay, next screen. Spend a few seconds on that so you can take a screenshot. And the next. Okay, hopefully those key points will help. Next. Finally, the debris removal program. Let's talk about that. That is one of the hottest topics after a firestorm. Usually it's in the very beginning. We do want to go over it to help clarify any confusion. So as you now know, or should know, that the Army Corps of Engineers is involved in clearing the sites if you opt in. If you opt in, it happens in phases. So you opt in. And I got to tell you, folks, for those of you that have limited debris removal coverage, then I think it's a great thing to opt in because the debris removal is very expensive. It's expensive because every lot is now hazmat. And to get rid of the hazmat, you need a licensed, a company that's licensed for hazmat removal. And that has to go to a special dump. And so it's not just like clearing regular debris. If it was just regular debris, it'd be a lot cheaper. But again, for those of you that have limited coverage, the opt-in program, they come out in phases. The first phase is you'll sign a right of entry, and it allows them onto the property. And they usually take the propane tanks, the 5-gallon paint buckets, if they're even survived, and anything that's loose that's considered hazmat, they'll take it away. And then the next phase is they'll make an appointment and they'll come out to the lot with the bulldozers and the big dump trucks and everything, and they start clearing the lot. And what's left is a hole in the ground where the house was. And so I would urge you strongly to be at the site when they schedule your debris removal. And here's something to think about. For those of you that have salvageable driveways and walkways, for whatever reason, let's say the driveway, some of you have long driveways, some don't. Walkways, you could have pavers, whatever it is. For some reason or another, if they survived and they're salvageable, you don't need to tear those up, because if you do end up either rebuilding or selling the property, the pavers and the driveways and walkways and the patios, those have value, and they would add value to the sale if you were selling the lot. Or you would, it adds value to the whole process of the rebuild. So what most people do is they'll put down big sheets of plywood before the big trucks come out and run over everything, and sometimes they damage it. But so hopefully that doesn't happen. So again, if your driveways and walkways are salvageable, then you can do that. Be on site. I would urge you to be on site. Look, it's not rocket science, it's debris removal. And so some of these, sometimes it's like having a bull in a china closet. With all due respect, it's hard work, and they're trying to move as fast as they can. So the opt-in, again, the advantage is that you get it done. And let's use some numbers, for example. Let's say you only have $75,000 available all in for debris removal based on the policy. And they go do the job, and then a bill comes in 8, 9, 10, 12 months later, and that bill is $150,000. Well, the difference gets subsidized. So they'll pull the $75,000 from the policy, and then the difference gets paid through the program. That's the beauty of the opt-in. And so most of these firestorms we've been involved in have the same setup. It's always the same. And it's a good thing that it's even available. It's great. If for those of you that opt out and don't do it, well, those folks will probably have a lot of money in debris removal. And remember, it's based on the base limit of coverage A, right? So if you have a $6-7 million policy, take 5% of that, it adds up. If you have a $10 million policy base limit on the dwelling, it's going to be a lot of money for debris removal. And the good thing there is that you can hire your own contractor as long as they're licensed for hazmat. and you've got more control. You can schedule it quicker. You've got control over the process. They're working for you directly, as opposed to a state provided program, so to speak. So, and for those of you that have a lot of money, then in debris removal, then that's an advantage. Now, I do want to say that debris removal is a process. I think there was 16,000 structures in this firestorm. That's a lot. So you need to be patient. And at the end result, what you want after the debris removal is done is a certificate of clearance. It's very important. The certificate of clearance will deem the lot clear and free of hazmat, and it will deem it a buildable lot. Without that certificate of clearance, it's going to be hard to get permits. So remember, whether you opt in or get your own contractor, the end result is that piece of paper, that certificate of clearance, is worth its weight in gold. So it's really important that you get that. That's me. Look, anybody that wants to have a one-on-one conversation, I'd be happy to do that. There's no cost. There is no obligation to hire us. We'd be happy to talk about your claim, your strategies, your goals, and reach out. That's my cell phone direct. My email is there. Let's schedule it, and feel free, to reach out and pick my brain. We do these all the time. I can certainly answer some of the tough questions that you just can't ask that insurance adjuster for fear of possibly damaging your claim or compromising your position on what you want to do. So anyway, with that said, I'm going to open up for Q&A. Okay, we got a few questions here. First one, does accepting partial payments from my insurer affect my ability to negotiate a higher final settlement later? The answer is no, as long as the check does not say it's a final settlement. Make sure that the check stub, the email, the electronic funds transfer, the EFT, make sure nowhere does it say this construes a final settlement. Otherwise, the partial payment is nothing more than what we call in our industry the undisputed amount. It's an advance against future payments. Are there any risks in depositing these checks? Again, the answer is no, unless it says this construes a final settlement. Once that's cashed, that's a problem. So make sure, again, nowhere does it say that check or electronic funds transfer construes a final settlement. Next question is, how specific does my personal property inventory need to be in order to receive a fair and accurate settlement? Well, since they've categorized it, I would go into the insurance code and see what it says. But basically, again, I would really, the more details you provide the insurance adjuster, the less they can argue. And where the arguments come in are not on the toothpicks and the forks and spoons, it's the expensive items. You start seeing line items of, $2,000, $3,000, $5,000 line item for whatever it is, $10,000 line item. You better provide some real accurate information there so that there's no room for interpretation. Remember, kill them with details. The more details, the less they can argue. Next question is, if the air quality in my home remains unsafe after the insurance approved cleaning, am I entitled to request additional remediation? Well, yeah, of course. You're owed back to pre-loss condition. Remember, pre-loss condition. That's what it says. No more, no less. Plus code if it's the building. And so, yeah, you are entitled to request additional remediation because you're not back to pre-loss. Do I have to move back in? Look, for those of you that have health concerns, there's been plenty of studies. I'm not getting into it here. It's not the right forum, but there's pulmonary studies done after the Paradise Fire. Just get online, do some research. Your health is the absolute most paramount thing in this world. So without that, you've got nothing. The house can be cleaned, deodorized, and made safe again. But if you move back in, you can compromise your health if it's not done properly. don't take that lightly. Next one is my mortgage lender allowed to require that insurance proceeds be applied towards my loan before I can use the funds for repairs or rebuilding? Yeah, the mortgage lender has an insurable interest. Remember, they lent you the money to buy the property. It's a collateralized loan. The property's gone. So how do they protect themselves? Basically, they get to control and dole out the money back to you. It's your money to rebuild. It's your money, but they're holding on. They want to make sure that you're spending it on the project and not going to Vegas to try to double the money or buy a fancy sports car or something. They want to make sure that the money's going back into the property, and so that's why there's a mortgagee clause in that contract of insurance. That's why they're listed on the declarations page as having an insurable interest in the property. So that's a legal thing that's got to be there. They can't force you to pay down the note unless you have some kind of manuscript mortgage documents. I've only seen it, I think, twice in my 30 years of doing this, where the whole note got called in, and this was back in 2008 when the economy tanked. For some reason, there was some kind of catastrophic loss language in this guy's mortgage documents that allowed the insurance carrier to call in the whole note. Here's the deed. Now you're sitting on a damaged property. You got to go take a loan out to rebuild. So that's hope that helps. Next question: am I allowed to sell my property while the insurance claim is still open? I wouldn't do that. You are allowed to do anything. It's your home. It's your money. But I think you damage your claim, and you're basically telegraphing your position. Furthermore, if you sell the property and the minute that you go buy a replacement property, your ALE money, the loss of use money, stops because now you've replaced your home. You now can move into a home. You've got a kitchen, bedrooms. You're back into a home. Doesn't matter that you have 3 years. Doesn't matter that there's more money in that account still available. But the minute you buy a property and you move in, the loss of use ends. So you are allowed to do whatever you want there, but it can damage your claim. What complications or obligations might that create? I just mentioned that. Okay, what are the potential drawbacks of waiting for the insurance company's offer before hiring an advocate? Well, you could damage your claim. You can make agreements up front that, look, it's kind of like, it's analogous to going to court. Like, you got a multi-million or hundreds of thousands of dollars of a settlement pending, and you go to court to defend yourself, and you know nothing of the law. Just throwing that out there. And the verdict comes in and you don't like the verdict, and you're like, wait a minute, judge, I don't like that verdict. I'm going to go get a lawyer or get an advocate to help me. Well, you can't unwind the clock. All the agreements that were made, that happened during this claim process is really hard to unwind. So if you're in the discovery phase, we call it, where the claim is still being put together and we're putting together numbers and nothing's been committed to and it's still malleable, then there's room that we can make a big impact on. So there is some drawbacks from waiting. Look, the insurance company's doing something. And if you're sitting back just waiting, a lot of people take this wait and see approach, and then they come to us months and months later, and there's so much hair on the claim that we can't unwind it. There's not a brush big enough to get the hair off that claim, and we can't do anything, and we can't add any value. The value add for when we're involved in a claim comes in the beginning, where we're controlling the narrative. We're operating within the four corners of the contract and of insurance, and we know how to apply these laws and where to push and pull. If you've never done this before, you're swimming uncharted waters. We have represented some of the most sophisticated minds in the country. Okay, we've been vetted out by some of the best, and with that being said, there's a reason they hire us. And so again, if you want to explore some of your options, feel free to reach out. I'd be happy to discuss on one-on-one, whatever is needs to be addressed in your particular claim. Hope that answers that. Hi, Susan. Thanks for the question. Do you have a detailed list of personal property items you could share with us just as an example, both to jog our memories and to give us a start to put together our own inventory list. We have what's called a primer, and it helps jog your memory. Look, like I said before, the personal property Susan claim is Susan, it's the hardest. It takes so long. Be happy to send that off. Why don't you shoot me an email? And my email is right there on the screen, and I'll be happy to have our inventory staff send you what's called a personal property primer. It's kind of a small template that'll help you put some lists together. But you got to do it right, and there's a way to do it, and it's an exhaustive process, that personal property claim. Again, I always say it takes years off your life. I used to have a full head of hair before getting into personal property. It is a tough one. So again, Susan, I'd be happy to send that to you. Just shoot me an email, and I'll respond to it with that personal property primer. Another question. I have State Farm insurance, and the booklet they gave me to complete for contents doesn't ask for monetary amounts, just age and condition. Will this affect my claim? Well, what they're doing is don't allow them to put the money on it, because remember, they don't have to be accurate. So again, State Farm has this proprietary online thing. It allows them to control everything. I would urge you to use your own template, your own Excel spreadsheet. You can hand it in on a paper napkin. Okay, there's no law that says you have to do it one way or another. They like to control it. Now, as far as the contents, you want to fill in the money. What does it cost to replace that item? And remember, add tax, because you're going to have to pay tax to buy it. And you paid tax already to buy it initially. Add a setup. If it's a washer dryer and they charge for delivery and setup, you're not going to spend all Sunday wrenching in a washer and a dryer. If you have the part of the claim. Tax, delivery, setup, and warranties. If you had furniture or something that you purchased an extended warranty, you got to add that in as well. And so in California, the age and condition's very important. Let's talk about this real quick. With personal property, it is not just the useful item of the useful lifespan of the item that calculates depreciation. It's the condition. For example, for those of you that have a guest room, and there's maybe just a couple that living in a house, and you have this guest room that's barely ever used, and the furniture is barely ever used, and the mattresses are barely, the stuff in there is in much better condition than a bedroom that's used every day. And so that's an example where condition coding, is it in excellent condition? Is it in fair condition? Is it in poor condition? That's going to drive the depreciation. Okay, that's what that's all about. The condition of it, not just the age, will drive the depreciation. And you got to be honest. You got to be fair and reasonable. And if you've got a house with 5 kids, 3 dogs, and 2 cats, and a couple of birds flying around, well, the wear and tear on that stuff is going to be much more than just a couple with a child or a pet. And so the condition really affects the claim. And that's, again, that plays a role in the depreciation part of it. And you fill in the money. Do not allow them to do it. Susan again. Hi, Susan. All right. Any suggestion on how to deal with the mortgage company that is holding a percentage of the insurance payments, but won't pay interest on the withheld amount, yet expect us to continue to pay them for accrue? This comes up a lot. Interest on all of the remaining amount of our mortgage. Doesn't seem fair. Well, you're right. It's not fair. Any executive orders or law on this? No, look, the banks and the mortgage companies are their own for-profit businesses. So some do pay money, interest on escrow, their interest-bearing accounts. Others don't. And I know we're paying interest to pay our mortgage. I get it. But I haven't seen anything or heard anything, Susan, regarding an executive order or law on this. It's really up to the bank, the establishment themselves. And so, I would ask them for it in writing. Show me in your policy somewhere where it says that if a settlement check comes into an escrow account, that it does not bear interest. There's got to be something in writing. That's what I would do. If they show it to you, then there you go. That's their policy. But otherwise, I don't think you'll be able to change their mind. If you got a banking like a Wells Fargo or a B of A or even a Mr. Cooper or something like that you're dealing with, big institution. Hope that helps, Susan. I don't see any more questions coming in. Okay, with that said, I want to thank everybody for joining. Hopefully, you got some decent information and to help you along with the process. Again, please feel free to reach out. No cost, no obligation. If you want to discuss things one-on-one, it's myself and a team of experts out here trying to help and guide people through this hard and long process of handling settlements for your insurance carrier claims. And it's not easy, folks. It does not go unnoticed. With that said, I wish you a good evening and thank you for joining.